Most investors say they're okay with risk, right up until their account drops and suddenly sleep gets harder. Picture this. You open your investing app. Your balance is way lower than last month. Be honest, are you curious or a little queasy? That reaction, in that moment, is your real risk tolerance. And it might be very different from what you say it is on a questionnaire. In this episode, we're going to talk about how to really know yourself as an investor. We'll look at what risk tolerance actually is, the difference between what you can handle and what you can emotionally live with, and how to turn that self-knowledge into a portfolio that fits you. All right, let's dive in. Think of investing like planning a long road trip. Everyone loves talking about the destination, early retirement, college for your kids, maybe a little beach house someday. That part's fun. But here's the real question. What kind of roads can you handle to get there? Are you a smooth highway, cruise control kind of person? Or are you okay with winding mountain roads, steep drop-offs, and sudden fog? Risk tolerance is less about bragging rights and more about matching the journey to your actual comfort level. Some people can ignore the bumps and just keep driving. Others grip the wheel at every pothole. Neither one is better. The key is honesty, because if you pretend you're a daredevil driver when you're not, the first sharp turn, the first big market drop, can send you straight off the road. That's when people panic sell at the worst possible time. So in this section, we're going to unpack what really shapes your tolerance for risk, your personality, your life situation, and your timing, and how to turn that into concrete investing choices. Let's start with you, outside of money. How do you react to uncertainty in the rest of your life? Ask yourself a few quick questions. When you're booking a flight, do you check prices once and just book? Or do you refresh 10 times, worried you'll overpay? When your phone battery dips below 10%, do you calmly wait it out? Or do you immediately start hunting for a charger? These tiny habits actually tell you something. They hint at whether big stock market swings will feel like a passing rain shower or a full-blown hurricane. And that emotional pattern matters just as much as the math. Now, to really understand risk tolerance, we need to separate two ideas that usually get mashed together. First, how much risk you can take. Second, how much risk you can live with without losing sleep. Let's put some clear labels on those. Think of risk capacity as the size of your backpack on a hiking trip. Risk capacity is the financial side of the equation. It's shaped by things like your income and how stable it is, your emergency savings and your debts, and how soon you'll need the money you're investing. If you've got a sturdy backpack, strong finances, and a long time horizon, you can carry more gear. In investing terms, that means you can handle more exposure to market ups and downs. If you've got a flimsy little day pack, tight cash flow, no cushion, money you'll need soon, then you simply can't carry as much risk, no matter how bold you feel. That's risk capacity. Now let's talk about the other side. Risk comfort is how you feel about the experience. It's like your feelings about heights on that same hike. Two people can stand on the exact same cliff ledge with the exact same safety gear. On paper, they have equal capacity. But emotionally, one person's taking selfies and enjoying the view. The other person is frozen, heart racing, staring at their feet. Investing works the same way. What looks perfectly fine in a spreadsheet can feel absolutely terrifying in real life. So to really know yourself as an investor, you have to line these two things up. Your risk capacity, your financial backpack, and your risk comfort, your emotional reaction to the heights. If your portfolio matches your backpack but ignores your fear of heights, you'll be tempted to turn back at the first overlook. If your portfolio caters only to your nerves but ignores what you actually need to carry, you might reach camp without enough food. Neither of those outcomes is what you want. So how do you find that balance? Here's a practical way to explore your true tolerance. Run some what-if rehearsals. Imagine your investments dropped by 10%, then 20%, then 40%. Not as abstract percentages, but as real dollars. Take a second and translate it. If you have, say, $50,000 invested, a 20% drop means seeing $10,000 gone on your statement, at least for now. Picture opening that statement and seeing that number. What thoughts pop up? Do you immediately start mentally cutting expenses? Do you think, I have to sell before it gets worse? Or do you think, that's uncomfortable, but I can wait this out? Those reactions are gold. They're data about your true risk comfort. You can even think of this like trying on jackets in a store. A very conservative portfolio might feel snug and safe, but also a bit constricting. It might not keep you warm enough for a long retirement. A very aggressive portfolio might feel sleek and exciting on good days, but drafty when the wind picks up. Fun when markets are up, miserable when they're down. You're aiming for the combination that feels a little roomy but still secure. Something you can move in without constantly tugging at the sleeves. That's your risk tolerance fit. In the next part, we'll turn these insights into simple ways to choose an asset mix that fits both your backpack and your fear of heights level. Now let's connect this to everyday life choices you already understand. First, think about how you handle job changes. Some people are totally fine joining a tiny startup with no guarantee it'll be around in 5 years. They like the potential upside and they accept the risk. Other people only feel okay at a big, stable company. They'd rather have predictability and a steady paycheck. Aggressive stock investing is a lot like the startup path. More upside, more excitement, but you have to be okay with uncertainty and rough patches. A more conservative portfolio is like working for that big, established employer. Fewer wild surprises, probably fewer dramatic leaps too, but more stability. Now let's look at housing choices. Renting is flexible, you can move, but it can also feel unstable. Rents can change, leases end. Owning a home ties you down more. It's less flexible, but it often creates more long-term security. A very safe portfolio is like locking into a long lease in a calm, predictable neighborhood. Steady, low drama, and maybe a bit limiting. Taking more risk is closer to buying a fixer-upper in an up-and-coming area. There will be dust, noise, and moments you wonder what you've done. But there's also more potential if you can tolerate the mess. You can also try a stress dress rehearsal. Here's how that works. The next time headlines scream bad news about the market or the economy, pay attention to your body. Do you feel tense? Do you want to check your accounts 5 times a day? Or do you think, this is annoying but it'll pass? Do this even before you're heavily invested. Your reactions now are clues to how you'll handle real volatility later, when more of your own money is on the line. As you start to understand your risk sweet spot, remember this: it's going to shift over time. Just like your taste buds change, from super spicy food in your 20s to milder dishes later, your risk tolerance can change too. Big life events can reset your comfort level almost overnight. Kids, layoffs, inheritances, health scares. All of these can change how much risk you want to take and how much you should take. So think of your investing plan like a GPS. You set the destination, but you'll sometimes reroute around traffic, or take a different exit, or stop for a break. You're not abandoning the trip. You're adjusting how you get there. The more honestly you log your reactions now, the more your future portfolio can feel custom-tailored instead of one-size-fits-all. Knowing your risk tolerance isn't a one-time quiz you take and forget. It's more like updating a map app that learns from every drive. As you live through real market swings, promotions, crashes, windfalls, you collect driving data on yourself. Use that history. Use it to tune your speed, your lane choices, and your pit stops, so your investing route fits the actual driver you've discovered you are. All right, let's bring this home with a quick recap and an action plan. So here's what we covered today. First, investing is a road trip, and risk tolerance is about the roads you can handle, not just the dream destination. If you pretend to be a thrill seeker when you're not, you're more likely to bail out at the worst possible moment. Second, we separated risk capacity from risk comfort. Capacity is your financial backpack, your income, savings, debts, and time horizon. Comfort is how you feel on the cliff, your emotional reaction when markets swing. A good portfolio respects both. Third, we talked about testing your tolerance with what-if rehearsals. Imagining a 10, 20, or 40% drop in dollars helps you find the mix that feels like the right jacket. Not too tight, not too drafty, something you can actually wear through all seasons. Fourth, we connected this to real-life decisions you already understand, like choosing a startup versus a stable employer, or renting versus buying. Those patterns reveal whether you naturally lean toward flexibility and upside, or stability and predictability. And finally, we said your risk tolerance isn't fixed. It evolves like your taste in food. Big life events can change both how much risk you can take and how much you want to take. So your plan should be like GPS, same destination, smarter routes over time. Now let's turn this from ideas into action. Here's your action plan for this week. 1. Take a few minutes to write down the key ideas that stood out to you about risk tolerance and knowing yourself as an investor. Just a half page of notes is enough. Writing it down makes it real. 2. Identify one specific area of your financial life where this applies right now. Maybe it's how aggressive your 401k is. Maybe it's a decision you've been putting off about starting to invest. Maybe it's noticing how you react to scary market headlines. 3. Take one small step this week that lines your money up with what you've learned about yourself. That could be checking your current mix, running a what-if rehearsal on your actual numbers, or simply tracking your emotions the next time markets move. If you do just those 3 things, you've turned this episode from something you listened to into something you used. And that's the whole point here. You're not trying to become a fearless, daredevil investor. You're trying to become an honest investor, someone who knows their own roads and chooses a route they can actually stay on for the long haul. Because in the end, the best investing strategy isn't the one that looks perfect on paper. It's the one you can live with through the potholes, the fog, and the surprise detours, all the way to your destination.